Congratulations! You've made it to the last module of our investing journey. It's a bittersweet moment, but I'm genuinely proud of how far you've come. Now let's make sure you keep more of your returns by understanding the tax implications of your mutual fund investments. Think of mutual funds like 3 different types of baskets, each with their own tax rules. First, if your basket is packed with more than 65% domestic equity, that's shares of Indian companies. Here's what you need to know. Hold your investment for over a year, and your gains are called long-term. These are taxed at 10%. Sell in under a year. That's short-term, and you'll pay 15%. And don't forget, any dividends are just added to your total income and taxed at your regular slab rate. Now, what if your basket has between 35% and 65% domestic equity? Think most hybrid funds here. For these, the clock runs for 3 years. Sell before that and your gains are short-term, taxed at your slab rate. Hold for more than 3 years and you get long-term treatment, taxed at 20% but with indexation. That means you get to factor in inflation, which can really lower your tax bill over time. Then there's the third category, baskets with less than 35% domestic equity. This includes debt funds, gold funds, international funds, and some hybrids. Here, it doesn't matter how long you hold, all gains are short-term and taxed at your slab rate. Here's a quick heads up about losses. If you lose money in the short term, you can offset those losses against any capital gains, long or short. But if it's a long-term loss, it can only offset long-term gains. Now, LTCG, or equity-linked savings schemes, are a bit special. Gains above 1 lakh rupees are taxed at 10% long-term capital gains, and there's no indexation benefit. How does this work with SIPs in equity funds? Imagine you invest every month for 13 months. When you redeem, the first SIP, now over a year old, gets long-term capital gains treatment. The rest, still under a year, are short-term and taxed higher. And don't forget the small stuff. There's a nominal securities transaction tax at redemption, plus cess and surcharge on all taxes I mentioned. So, what's the smart strategy? Simple. The longer you hold, the more tax efficient your investment becomes, except when you're dealing with funds with less than 35% equity. Finally, a quick disclaimer. KYC registration is mandatory before you invest. Only invest with SEBI-registered mutual funds. Need help? The Franklin Templeton India team is just a call or email away, and you can always check SEBI's website for more info. That's a wrap on this module. You're now ready to make smarter, tax-savvy investment choices. Thanks for sticking with me. Happy